People trying to figure out what's driving this market sell-off. There's a lot of talk now from different corners. Jefferies strategist David Zervos, for instance, saying that sovereign wealth funds from oil-producing countries have already boosted their oil production, devalued their currencies. We're now looking at sovereign wealth funds releasing or selling what they can and replacing the savings glut with an excess selling glut. I wonder what you make of this theory that the sell-off is an energy market margin call.
So I think there's some truth in saying that sovereign wealth funds are no longer there to step in and buy when markets sell off. You know, they are pretty special because they've got what they've called patient capital. They can underwrite a lot more volatility, and they simply do not have the same ability to come in. But it's part of a much bigger issue, and that is a change in both the liquidity regime and the volatility regime, which has changed the attitude. It's no longer about buying on dips, it's now sell the rally.
And what structurally changed to make that the case? I feel like just 6 months ago, it was buy the dip.
So a couple of things have changed. First, the central banks no longer have investors' back covered. They either are unwilling, in the case of the Fed, or increasingly unable, in the case of China, to repress financial volatility. And as volatility goes up, risk-taking comes down. Second, I think there's a recognition that there is no patient capital to step in, and the broker-dealers aren't willing to expose their own balance sheet to the extent that they were before. It's the delusion of liquidity that we have had all over the market. So put these two things together, and not only do you get the increased volatility, which is here to stay, but you get the downward trend.
Shouldn't other sources of capital replace the traditional broker-dealers in providing that liquidity, private equity, hedge funds? I mean, there should be a whole assortment of options in the financial institutions industry that can offer that kind of liquidity.
Yeah, they will, but at lower prices, right? So in one case, broker-dealers were right in the middle of the financial transactions. You're talking about end users, and end users move more slowly, and they cannot connect directly. Remember that, they cannot connect directly. So broker-dealers still play a very important role. So it will happen. We will get stability, but it will be at lower levels.
When you were talking about volatility, it does seem to be in some ways specific to the U.S. If you come inside the Bloomberg terminal, I have the VIX index, which is the white line that you'll see here, versus the euro dollar versus the dollar yen. And you can see that the volatility, the move in the VIX has been much stronger, meaning we haven't really seen these cross-border flows. What does that tell you about our exposure?
So it's interesting because you can either say the VIX is lagging or leading, and I think it's both. It certainly is lagging segments that we've talked about before that have been totally unhinged. If you look at what's happening to the high-yield market, if you look at what's happened to the oil market, if you look at what's happening to the emerging markets, those are totally unhinged markets where not only do you get volatility, but you get this concept of volatile volatility. Right? So the VIX has been lagging those. And I think the VIX is leading other market segments that still haven't caught up to the reality that we have changed volatility regimes.
Interesting. Paul Krugman was writing over the weekend about how oil has gone kind of non-linear, right? A 10 to 20% drop in oil prices works in the conventional way, in a very linear way, but then a 70% drop in the price of oil has really drastic effects on producers. It creates liquidity, constrained behavior, extreme behavior, non-linear behavior, and it doesn't really show up on people's radars or their models. What else, as we go through this risk sell-off, are we seeing in terms of non-linear behavior, non-linear responses?
So you're seeing it in the emerging world, very non-linear there. And even though there's value, very few people want to step in because it's become non-linear. And another word for non-linear is unpredictable, right? And people don't like unpredictable element. It also means that the damage that you create is no longer symmetrical. So in the case of the oil market, the impact on producers, negative, immediate. The beneficial impact on consumers takes a little bit longer to work through because consumers don't react that quickly. So you get this asymmetry in response time, all of which makes people want to reduce risk. And it's not just a financial issue. If we're not careful, it can become an economic issue too.
So tie it all together for us. You have the rise of volatility. You have the lack of liquidity overall in the markets. What winds up happening now if central banks can't help us? Would we have to get used to it, suck it up?
So we definitely have to get used to it, and individual investors have to be sure that they have the resilience to navigate this, and then they have the agility to respond, because good names get trashed, and they create enormous value longer term. In terms of where we go next in a bigger issue, and this is something that I've written a book on, we're coming to the T-junction. Nothing is predestined. If the policy response finally materializes and goes well beyond central banks, as we've discussed, you can validate financial asset prices and take them higher. But if the policy response does not materialize, then we're looking not just at financial instability, but we're looking at even lower growth with a much higher probability of recession.
And as you're talking, Mohamed, I just want to mention that crude oil now sinking to their session lows. If you look at WTI, Alex, 28.56 at the worst levels of the session, off by 2.9% right now.
Mohamed, why is this not 2008?
2008 was scary because it was a payments and settlement system. That's the most basic element of a market economy. It's my ability to trust that I will give you the money now and get settlement in 1, 2, or 3 days. That was in doubt. Banks no longer wanted to face each other. They no longer trusted the payments and settlement system, which brought the whole system to a halt. We don't have a payments and settlement problem. If anything, the payments and settlement system today is very strong, and the banks are in better shape. So the risk has migrated outside the banking system and gone elsewhere. So the shock now is much more financial volatility. It's much more lower risk-taking, but it's not the payments and settlement system. This is not 2008.
Yeah, that counterparty risk doesn't exist the way it did back then, I guess.
Right. Well, unless you're a bank that has a lot of energy loans outstanding and you're not diversified, maybe that would be a different story. All throughout the weekend, Mohamed, I was reading, paper after paper about how we're going to see another decline in the S&P, a short-term bounce, another sell-off. Doug Ramsey coming out with a 10% decline call in the S&P to 1,700. What do you see?
So that is a risk, because we have decoupled financial markets from fundamentals. And those who are filling that gap, central banks, are no longer as effective or as willing to do so. So there is a risk of another air pocket, another 10% fall. That certainly is out there. As I say, we are now in uncharted waters, because this volatility and liquidity change is something that the market has got to price in. And price discovery takes a long time when you don't have broker-dealers who help you along the way.